It seems like the latest trend in social media is that you can buy a business with no money down. That's nothing farther from the truth. Remember what happened in 2008 where people thought they could buy real estate with no money down? Well, you know what happened then. So as a professional M&A advisor, I can tell you that buying a business with no money down is nothing but a pipe dream. And I'm going to tell you the 5 reasons why in today's video. Let's get to it. Hey everybody, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy and scale a profitable business. If you are a small business owner looking to buy a profitable business, or a W-2 employee sick and tired of the rat race wanting to get out by buying a profitable business, you are in the right place. Please subscribe to my channel and don't forget to hit the bell. You'll be notified every Thursday when new content comes out. Number 1, first of all, sellers hate it and find it disrespectful when you have no skin in the game. Now, whatever you think you may know about buying a business, let me tell you, the game of buying a business has changed. There are 15 qualified buyers for every good business out there. Now, if you're looking at businesses that are north of $500,000 worth of seller discretionary earnings, then you got even more competition. You got the private equity groups, the family offices, the professional institutional buyers, those who actually write checks when they buy a business and need no financing. So if you're trying to get a hold of a really good deal, a business that's been around for 25 years, that has 20 plus employees, that has over $500,000 worth of SDE or adjusted EBITDA, has a brand recognition, it's really a key, it's known in the marketplace, it dominates, it's in the top 3 players. You're not gonna come at this owner, expect to put nothing and expect the seller to carry 10, 20% and the bank gives you 80%. It just doesn't happen. And sellers feel uneasy about transferring their life's work to someone they don't even know, who may or may not have industry experience, where they care deeply about their employees. They want to make sure that their legacy stays intact. So they want to make sure you're in it to win it. You're in the game. A down payment shows that you're serious and you're responsible. But that's to the seller. To the brokers, it shows that you're qualified. It shows that you really are serious and you're playing like a professional. No professional buyer will ever try to do this bait and switch. We want to give you fair market value for your business, but by the way, will you be willing to finance the 100%? I don't know where you hear that. Some of the gurus talk about that. As having closed over $100 million worth of deals myself, I've never seen it happen. I've never taken any buyer seriously who comes to me trying to get one of my listings with no money down. They don't even get through the door. They don't even get to talk to the seller. Sellers want to see a buyer's ability to handle the financial obligations. And that is evidenced by your ability to put some money down, because if you have $100,000, $200,000, $300,000 down, it shows that you have been very judicious in saving that money for that specific purpose, that you prepare yourself for that. So number two is you got limited financing options. Now, think about it this way. Why would a SBA preferred lender of the top 10 lenders in the US would take 100% of the risk on a deal and you take none? Let me give you an example of what some of the gurus talk about. Okay, you can actually get a 90% LTV, loan to value in the deal, and you can have the seller carry 10% and you put no money down because you're gonna save your money for working capital or elsewhere. Now, and there's only one situation where that happens, but let me get to that in a second. And even if you had a FICO 740 and you're trying to do that, it's not gonna work. It's not going to work because most banks will require the buyers to invest their own funds. That is actually an SBA rule. An SBA rule is that there's got to be some money at play, some equity. We call it equity. There's got to be an equity injection from the buyer. Now, if you hear somebody tell you otherwise, they're crazy, right? Now, there's only one reason why, and the lender would say, hey, look, you know, that makes sense for you to put it down. And the reason is when you're coming in from a very similar industry, you are an industry operator in that particular NAICS code, you have a business and a balance sheet that is healthy, robust, working capital, you have positive working capital, you have great current ratio, have great debt to equity ratio, you're an industry operator with many years of experience under your belt, you understand the KPIs, you understand how to run a business, you understand the nuances of this industry, and you're gonna leverage your hard-earned balance sheet sheet, your positive balance sheet with nice equity, and at that time, the down payment is moot for somebody who is at that caliber, because you have demonstrated over many years of you running a business that you are very little risk to the lender. So obviously, every buyer is going to actually personally guarantee each loan. So if you're a first-time business buyer trying to buy it, you're going to be scrutinized out of the deal. You're not going to have a chance. So that's number 2. So number 3, it's high competition for deals. As I said a little bit ago, there are 15 buyers for every good business out there. Now, there are some other stats that you probably need to know. Only 10% of buyers will ever buy a business. And of those 10% of buyers that will ever buy a business, 9 out of them are professional buyers. So at least 0.1% of the other buyers. So the stakes are high. There's a lot of competition. Cash offers. I have multiple deals in 2024 in which I put the business on the market, one of my listings, and it had hundreds of inquiries within the first 24 hours. People that were coming in with very high net worths, with high evidence, and they were showing me everything that I needed, the personal financial statement, their buy box and everything. It made sense. They had the proof of funds and then some, and they were willing to put 10, 20, 30% down. So think about that. If that is your competition for a very successful business, what are the chances of where do you fare? How are you going to rank? If I had a choice between 3 buyers, 2 of them have $1 million in cash and the business is $1.5 million, they don't have to put the whole million. They could put $500,000 and you have nothing. Who do you think I'm going to choose? So think about that long and hard. Are you stuck in trying to figure out how to buy a business? I am here to help you. Please connect with me. If you have questions, I have answers. I'm sure that there are many things that are going through your mind as you're trying to buy a business. What is the right price to offer? Should you offer less than you should have? Should you get the deal pre-approved? What kind of offer do you make? Asset purchase, stock purchase, and why? Should you be getting into those types of industries like the trades or not? Should you get into professional services or not? I'm here to help you. All I want to do is guide you in the right direction. So click on the link below, just connect with me or drop me a comment or shoot me an email. Email address is up here and let's connect. Now, there are times right now, this is turning into a seller's market. It's no longer a buyer's market. As the interest rates, the federal rate, the prime rate begins to go down, it's actually a good thing for the sellers because it allows for higher debt service coverage ratio. The higher the interest rate, the higher the principal and interest payments, which means the debt service coverage ratio is going to be compressed lower. It's harder to buy. Now, if you're in obscure industries where there's no competition, you may be able to get away with a whole lot of things, but not in very successful businesses. Number 4, cash flow and contingency concerns. Businesses often require additional investment post-acquisition, such as working capital, which it can provide without funds. So I talked about the 0% down, which doesn't exist. So that's one bucket. Think of it in terms of 3 buckets of cash that you need to be aware of as a buyer. Number 1 is your down payment. It's your equity injection, your 5 to 10%. Now, sometimes you can get away with 5%, but I don't want to confuse you right now. Think 10%. Now you got your working capital. Depending on the size of the deal, it can be anywhere from $50, $100, $150, $200,000. Probably a business at about $2 million is going to need about $200,000, $150 to $200,000 worth of working capital. Now, the whole concept of working capital is convoluted and it's complex, and it's usually a calculation that is done during due diligence to true up. And very successful and very shrewd buyers will actually work their working capital into the offer and have the seller pay for it. So that's the second bucket of cash that you need. And the third is post-closing liquidity. Now, do you have to have cash upon close? No, but you have to have readily convertible instruments to cash, because there's always that risk. If you have $100,000 and that's all you have, the lender is not going to let you put all $100,000 and leave you with nothing. It's just bad business. So you need to have some money set aside, maybe a HELOC, access to cash, convertible stock, or savings, a money market account, anything that you can tap into. You may never need it, but it's good to have. And very few lenders are going to let you get away with not having anything. Now, and here is the kind of what the lenders are trying to anticipate. Now, when you're buying a business, you're paying for the past performance and you're betting for the future performance. So you're buying on the past and you're betting on pro forma work. Now, and whenever you're doing an asset purchase, what you're buying is cherry picking the assets from the old co into a new company, the new co, what we call it, right? And as you're taking those assets, you're not going to get AR, neither you're going to get AP, which means that the very first month, your biggest expense is payroll, your wages and your bennies and everything related to wages. And depending on the type of business that you're in, it may range anywhere from 30, 40 to 50% of your total operating expense. So imagine if you have $100,000 worth of payroll and a very successful business, but if you work through the month and you don't do the billing until the last day of the month, how are you going to meet the payroll for the first two cycles, the first month? That's why you need working capital. Now, when the business is ongoing and you're generating AR, which is turning into cash, and you're converting every 30 days, then that's no longer the problem, because the business will generate enough AR to cover the AP and everything else, so you'll have working capital. So sellers want assurances that the buyer has the financial reserves, right? A no money down buyer risks over leveraging. So here's the thing that you need to understand. It's all about debt service coverage ratio, which we call DSCR for short. So we are looking at deals. Lenders want 1.5 or better. So sometimes if you're putting no money down, how are you going to get to the 1.5 to get the deal approved? So at the very basic level, whenever you put an equity injection, there's less required. So if you put in $100,000 into $1 million purchase on a $350,000 SDE calculation, for instance, now you're going to need a $900,000 loan, plus you're going to have the guarantee fees, and you're going to have to come up with the working capital, or you're going to ask for it. So think about it. You have a $900,000 loan amortized over 10 years at prime plus 2 or 3 points. So depending on how you price the cash flow and how, according to the NAICS code, it behaves, and depending on the competition, you may have to pay more for that cash flow stream depending on the demand for that type of industries. There are some industries in hot demand, which means that all of those calculations go out the window. If you want to compete, you have to put at least 10, 20% down so you can have a digestible mortgage. It's no different than when you're buying a house, right? The more you put down, the lower the mortgage. It's a similar principle. Now, five and not least, skepticism toward creative deals. Now, I hear just about every one new reason every year, every week, of somebody who wants to do a creative deal with me. Let me tell you, I always take cash any day over a creative deal. Creative financing, like a seller financing or earnouts, often depends on the seller's confidence in your experience and reliability. Now, if you put in 10% down, then the seller is going to want to pony up. Most likely to put 10% down, and a seller carry, you have 80% loan, then whether you put in 0% down and let them carry the 10. It's just everybody, to make the deal work, everybody has to put something in. For you to win something, you must lose something, right? It's negotiation, a win-win. Without upfront capital, you might struggle. First-time buyers lack a track record. That's your biggest challenge. You don't have a track record, so makes the sellers hesitant to trust you with financing structure. Why would they become the bank if you're an unknown commodity? This is the reason why sometimes 0% down works when you're a seasoned pro in that industry. If you're very well known in the industry that you're in and you want to buy one of your competitors and your reputation precedes you, then you can actually have trust. People do business with people who they know, like, and trust. If you're known in the marketplace, they're most likely to like you and eventually trust you to become the bank for you. I did a deal this year in which the buyer was so strong that the seller was willing to become the bank to the tune of 80%. We skipped the whole SBA loan, and they put 20% down. That's how it works. So I've given you the 5 reasons why buying a business with no money down, it ain't gonna happen. All right, good luck. For a limited time, we're giving away our cash flow calculator, also known as the Deal Analyzer 2.0, which is a great tool in Excel where you can calculate at least a dozen different items like cash on cash return cap rate, before debt service coverage ratio, post debt service coverage ratio, average 3-year SDE, and then some. It's my gift to you for watching my content, and it'll help you get to where you need to go as far as making an offer on a business. I'm also giving away my buyer's checklist, which is a 6-page document with a collection of over 100 data points that you need to collect through the process of buying a business. Basically, your punch list when buying a business used by us professionals. That's my gift to you as well. Just follow the links, download it, and it'll be my gift to you. Thanks for watching my channel.